America is standing directly on a massive fault line. On the surface, Wall Street is popping champagne. Tech stocks are exploding into the trillions, and the official headlines scream that the economy is booming. But beneath that glossy manufactured exterior lies a terrifying fracture. Housing, the absolute cornerstone of middle-class wealth, is violently breaking apart in total silence. And the one company millions rely on, Zillow, is completely missing the biggest crash since 2008. Rewind just a few short years. In 2020, with mortgage rates resting near 3%, a standard home meant an affordable monthly payment. By 2023, rates aggressively surged past 7%. That exact same house now requires a punishing 60% jump in cost. But prices didn't drop to compensate, they exploded. Fueled by cheap pandemic money, the cost of owning a modest home now forcefully eats $40,000 a year. This isn't a tight budget. This is total suffocation.
America is standing on a fault line. On the surface, Wall Street is celebrating record highs in the stock market. Tech valuations are soaring into the trillions, and headlines suggest the economy is booming. But beneath that glossy exterior lies a fracture widening every month. Housing, the cornerstone of middle-class wealth, the one asset most families rely on, is breaking apart in silence. The headlines don't match reality, and the company millions trust to measure home values, Zillow, is missing the biggest housing shift since the Great Recession. Rewind just a few years. In 2020, with 30-year mortgage rates near 3%, a $300,000 home meant a monthly payment of about $1,260, affordable for the middle class. By 2023, with rates climbing past 7%, the same home required over $2,000 each month. That's a 60% jump in cost, with no change in price. But here's the real kicker. Prices didn't stay flat. They surged. Fueled by pandemic migration and cheap money, homes in Florida, Georgia, Tennessee, and Texas leapt 30 to 50% in value in less than 3 years. The result? A generation-defining affordability crisis. With median household income around $74,000, the annual cost of owning a modest home in many metros, including mortgage, property taxes, and insurance, eats $40,000 or more. Over half a family's income is gone before groceries or gas. This isn't stretching a budget. This is suffocation, and yet official data looks calm. Zillow says Atlanta is down 2%, Nashville 3%, Tampa 4%. Nothing shocking, at least on paper. But these numbers are illusions. They measure only closed sales. They ignore the homes that sit unsold for months, slashed from $600,000 to $525,000 to $480,000, and still empty. They miss the properties pulled off the market entirely after no offers arrived. Those invisible homes are the real market signal, and they tell a story far uglier than a 2% decline. Consider Tampa. Homes once valued at $600,000 now sit at $450,000 with no buyers. In Dallas, builders are dangling $50,000 discounts and mortgage buydowns just to keep subdivisions moving. Nashville, once a short-term rental darling, is drowning in empty condos purchased for $700,000 during the boom, now struggling to sell at $550,000. These are not minor corrections. They are devastating losses, hidden in plain sight. The danger is how quietly this collapse is unfolding. Unlike 2008's foreclosure wave, this time there's no dramatic spark. It's a slow bleed. A family lists their home, cuts the price twice, then pulls it off. An investor accepts a six-figure loss. A builder throws in free appliances and $75,000 cuts just to clear inventory. These events don't make headlines, but together they form a picture of systemic decline. Wall Street may cheer record highs, but families are locked out of homeownership, investors are hemorrhaging cash, and builders are suffocating under debt. Housing isn't cooling, it's seizing. And when a debt-driven market collides with unaffordable payments, the outcome isn't stability, it's collapse. To truly see how deep the damage runs, we have to look beyond families clinging to stability. The first real cracks show up with the people who can't wait. Investors and builders. They're already bleeding. And their fire sales are pulling back the curtain on a crash that's far worse than Zillow's glossy charts suggest. If families are the glue holding the illusion together, investors are the dynamite blowing it apart. Unlike homeowners, investors don't ride out downturns. They can't. Housing to them is math. If the math stops working, they cut their losses. And those cuts are the most honest signals of where this market is really heading. Take suburban Atlanta. In April 2022, Blackstone, one of America's biggest private landlords, bought a 6-bedroom home for $515,000. By the following year, Zillow claimed it was worth $540,000. But by early 2025, it was listed at $494,000. No buyers came. 4 price cuts later, it sat at $399,000, $120,000 below the purchase price, and still unsold. That's not a blip. That's an implosion. Across the country, the same story repeats. In Orlando, investor homes bought near $600,000 in 2022 now sit idle at $480,000. In Dallas, corporate landlords are liquidating portfolios, slashing 15 to 20% off asking prices. In Miami, once a playground for foreign buyers and short-term rentals, luxury condos purchased for $1 million now chase offers at $750,000. The Airbnb dream that fueled the frenzy is turning into a nightmare of vacancies, HOA fees, and mortgages that bleed red every month. Builders are no safer. Unlike families, they can't wait out the storm. Every finished home sits on a construction loan, interest compounding daily. Unsold inventory burns cash like gasoline. That's why builders are leading the race to the bottom, cutting $50,000, $75,000, even $100,000 off sticker prices. They throw in granite countertops, upgraded appliances, and mortgage buydowns. But behind the curtain, the true selling price is far lower than official numbers admit. Take a Dallas subdivision. In 2022, homes sold for $480,000. Today, listed at $445,000, buyers also get $50,000 in incentives. The real price? Closer to $395,000. That's a 17% collapse hidden from Zillow's averages until months later. Multiply that across thousands of homes, and you see a market already deep into correction. This is what true price discovery looks like. Families holding on keep averages sticky. But investors and builders, forced sellers, strip away the illusion. Each discounted sale resets comps, drags down appraisals, and forces surrounding homeowners to confront reality. It spreads like a virus, neighborhood by neighborhood. The investor meltdown is the first domino. What starts with a handful of fire sales cascades into broader collapse. By the time Zillow's delayed charts admit the truth, the foundation will already have cracked wide open. The averages everyone sees, those smooth Zillow lines and realtor talking points, are built on closed sales. But closed sales tell only half the story. The other half, the half that reveals the crash in real time, is hidden in plain sight. Inventory explosions, affordability math that no family can survive, concessions that strip tens of thousands off official prices, and homes sitting unsold for months. Start with supply. Between 2022 and 2025, active listings exploded, up 254% in Atlanta, 180% in Orlando, and more than doubled in Phoenix, Dallas, and Tampa. Economics. 101 says when supply outruns demand, prices collapse. Yet Zillow claims Atlanta is down just 2%. The truth is masked because every home pulled off the market after repeated cuts vanishes from the averages. Thousands of failed sales don't exist in the data, but they exist in reality. Affordability tells an even darker story. Look at Florida. A median Tampa home is $410,000. At 2020's 3% mortgage, that meant $410,000, $1,730 a month. By 2025, at 7%, it's nearly $3,000. Add property taxes and insurance premiums that now average $6,000 to $10,000 a year, and ownership costs blow past $40,000 annually. With Tampa's median household income around $63,000, more than half is gone to housing alone. That's not a market, it's a trap. Builders' concessions reveal another layer. In Dallas, buyers quietly walk away with $30,000 to $50,000 discounts. In Phoenix, upgrades worth $10,000 are tossed in free. These unofficial cuts don't hit the stats until closing, but they gut values in real time. Time on market is the final red flag. In Nashville, homes that once sold in a week now linger for 90 or even 120 days. Each month unsold adds pressure, forcing $20,000 or $30,000 cuts. A house listed at $550,000 in spring might limp into winter at $480,000. Zillow's models smooth that decline, but the damage has already been done. These overlooked numbers scream what the polished charts whisper. Affordability has collapsed, inventory is suffocating, and real prices are already down 20 to 30% in many neighborhoods. The crash is not in the future. It's already written into the data nobody talks about. If the math is so brutal, why does the market still look calm? The answer lies in psychology. Housing doesn't reprice instantly like stocks. Sellers resist losses, buyers hesitate, and averages look stable until reality crashes through. Consider a family who bought in 2019 for $300,000 with a 3.25% mortgage. Their payment, $1,305. Even if their home is now worth $250,000, they stay put. Their job is steady, their payment unchanged, their life uninterrupted. On paper, they're underwater. In practice, nothing changes. That stickiness props up averages, keeping Zillow's numbers deceptively calm. But investors don't have that luxury. A flipper with 3 Las Vegas condos financed at pandemic peaks isn't cushioned by sentiment. If nightly rents can't cover mortgages, HOA fees, and cleaning costs, the math screams sell. And when they sell, they cut hard. Units bought for $400,000 now chase buyers at $320,000. Each cut drags down comps, forcing neighboring owners to face reality. Builders are trapped too. A family can wait years. A builder can't wait months. Construction loans pile interest daily. That's why they slash, offer upgrades, and accept brutal losses. They are forced sellers, and forced sellers set the floor. This psychology delay is why markets look calm, until they don't. Warren Buffett warned of this in 2005. One optimistic buyer can sustain an illusion for a neighborhood. But once speculators fold, values don't slide gently. They collapse in steps. We're seeing those steps now. Miami high-rise condos bought for $1 million in 2021 are now listed at $800,000 and still unsold. Investors, unable to rent profitably, are bailing. Each closed sale pulls the floor lower for everyone else. The psychology trap creates a split reality. Families waiting it out make charts look stable. But investors and builders, forced into fire sales, reveal the truth. And once enough forced sales ripple through, the illusion collapses. Prices don't drift down, they fall off cliffs. Crashes never stay contained. What begins in Atlanta or Orlando spreads outward, destabilizing entire states, then the nation. We're watching those dominoes tip now. Dallas-Fort Worth shows the blueprint. In 2019, median homes were $300,000. By 2022, they hit $420,000. Builders flooded the region with subdivisions, convinced demand was endless. But when mortgage rates doubled, the engine seized. Now, unsold homes pile up. Builders slash $50,000 off prices, $20,000 in upgrades, and rate buydowns just to move units. Officially, median sales still hover in the $400,000. In reality, homes sell closer to $360,000, a 15% cut hiding in plain sight. Chicago's suburbs echo the trend. Homes that once sold in days now sit for 90. Sellers cut $20,000, then $30,000 more, and still face silence. Zillow shows flat reality is eroding underfoot. The West Coast is cracking too. Phoenix inventory has doubled since 2022. Homes bought for $500,000 relist at $430,000 and go unsold. Sacramento suburbs have slashed 10 to 20%. Pandemic migration booms are reversing into busts. National math seals the verdict. With a median home price of $430,000 and 7% mortgage rates, monthly payments hit $2,860. Add insurance and taxes, and yearly costs exceed $36,000. With median household income at $74,000, half is consumed by housing before food or healthcare. Buyers aren't retreating out of fear. They're retreating because the math doesn't work. And here, Zillow's credibility collapses. In 2008, they downplayed Las Vegas and Miami even as they imploded. They're repeating that error today, smoothing away investor losses and builder fire sales. Zillow says Atlanta is down 2%. Reality is closer to 30%. But this isn't just housing. Insurance premiums up 50% in Florida push owners into foreclosure. Construction layoffs spread as projects stall. Realtors, brokers, and appraisers lose jobs as volumes collapse. Consumer spending, long fueled by cash-out refinances, shrinks as families realize their piggy bank is worth less every month. One domino tips the next. Investors, builders, homeowners, banks, local economies, GDP. The chilling part, how quiet it feels. There's no Lehman Brothers moment yet, no headline collapse. Instead, it's creeping forward invisibly. A Dallas subdivision littered with for sale signs, a Miami tower slashing prices, a Phoenix neighborhood flooded with inventory. By the time the averages catch up, the crash will already be everywhere. The illusion is ending. What looked like a stable market is a house of cards, propped up by charts that conceal reality. The affordability math, the investor panic, the concessions, the swelling inventory, they all point the same direction. The crash isn't coming. It's here. And it's spreading, one domino at a time.